Every 60 seconds, U.S. housing debt rises by over $1.5 million. That's not just a number, it's a ticking time bomb. Today, home prices aren't just high, they've shattered records, soaring even higher than the infamous 2008 peak. Yet, somehow, the frenzy continues. Families stretch paychecks, investors bid sight unseen, and whispers of buy now or be priced out forever echo across the nation. It feels like déjà vu, as if America is replaying the opening act of a tragedy we swore we'd never see again. But this time, the stakes are different, the players bigger, and the risks hidden deeper in the system. And what lurks beneath the surface may be far more dangerous than the last crash. To understand today's housing storm, we have to rewind just a few years. When COVID struck, the Federal Reserve slashed interest rates to near zero, flooding the system with cheap money. Stimulus checks poured into households, mortgage rates hit historic lows, and suddenly buying a house felt not just possible, but urgent. Wall Street saw the opening too. Hedge funds and corporate landlords swept across America, scooping up entire neighborhoods with cash offers ordinary families couldn't match. Homes that once built communities became assets on spreadsheets. In city after city, prices rocketed upward, leaving working families gasping for air. Meanwhile, renters faced their own nightmare. Rents soared to record highs, often rising faster than wages. For millions, the American dream wasn't just slipping away. It was being locked behind a gate controlled by corporate landlords. This wasn't random chaos. It was a perfect storm of policy decisions, corporate opportunism, and a nation desperate to cling to stability. But beneath the headlines and political speeches, one truth became impossible to ignore. Housing was no longer about homes. It was about power, and history has a way of repeating itself. And the next chapter looks darker than ever. Every bubble has its winners, and in today's housing market, the victors aren't young families chasing their first home. They're the giants with bottomless pockets. Hedge funds, private equity firms, and megabanks are buying houses the way most of us buy groceries. In bulk, sight unseen, paying in cash. The faster prices climb, the more they celebrate. Then come the corporate landlords. Companies that once dabbled in property management now own tens of thousands of homes, raising rents year after year, squeezing families who have no other choice. To them, a house isn't shelter. It's a product, a line item designed to generate endless profit. And where are the policymakers sworn to protect the public? Many stand at podiums promising affordable housing initiatives, while quietly accepting donations from the very institutions driving prices higher. They talk about fairness, then vote for loopholes that let speculators feast on the middle class. The hypocrisy is breathtaking. The betrayal stings deeper because ordinary Americans are told it's their fault, that they didn't save enough, or that they waited too long. Yet the truth is clear. This system isn't broken. It's working exactly as designed, for those at the top. But in every story of manipulation, there's always a truth fighting to be heard. Every drama needs a hero. In this story, it isn't a politician or a billionaire swooping in to save the day. The hero is colder, quieter, and impossible to ignore: the data itself. Look at the charts. Wages have barely budged in 2 decades, creeping upward at a snail's pace. Meanwhile, home prices have surged like a rocket. In 2000, the median home cost just over 3 times the average American's yearly salary. Today, it's more than 6 times. That gap isn't just a statistic. It's a canyon swallowing the dreams of an entire generation. Economists have been waving red flags for years. Whistleblowers in the lending industry whisper about risky loans making a comeback. Independent analysts warn that affordability has collapsed to levels not seen since, yes, 2008. But their voices are often drowned out by cheerleaders insisting that this time is different. Behind these numbers are real lives. Families who thought they'd buy a starter home but remained trapped in rentals, watching rents climb each year like clockwork. Millennials who did everything right. Went to college, saved, worked hard, only to discover that homeownership is now a luxury reserved for the privileged few. Parents move back in with their kids, young couples delay having children, and millions give up entirely on the idea of ever owning a home. The pain isn't abstract. It's lived daily by millions of ordinary Americans. And while data provides the proof, their stories give it a heartbeat. And then, a chart surfaced that turned whispers of a bubble into screams of crisis. Then, the wind shifted. Mortgage rates, once at record lows, suddenly spiked. What had been cheap, almost irresistible borrowing turned into a burden overnight. Buyers who once lined up with offers above asking price vanished. Demand cooled. Open houses grew quieter. Sellers, who just months earlier believed their homes would sell in days, began to panic. The headlines followed fast. Housing market slowdown begins, blared newspapers and financial sites. Talk show hosts debated whether this was simply a correction or the first tremor of something far worse. Fear spread like wildfire online. On TikTok and Twitter, anxious buyers and sellers shared their horror stories. Some compared the moment to 2008, posting side-by-side charts. Memes of housing crash 2.0 flooded feeds. The very phrase became a trending hashtag, amplifying anxiety across millions of screens. The tension was undeniable. Every news cycle brought fresh statistics. Home sales dropping, affordability plunging, inventory swelling. People began to wonder if the dream of homeownership was about to become a nightmare for those who bought at the peak. But the next chart doesn't just suggest a slowdown. It hints at collapse. Then came the number that froze economists in their tracks. The Housing Affordability Index, once a quiet gauge tucked inside reports, sank lower than it had even before the 2008 crash. For the first time in recorded history, the typical American household needed 44% of its income just to cover a mortgage payment. Nearly half of every paycheck, gone before groceries, healthcare, or childcare are even considered. The warning signs piled higher. Housing debt ballooned to record levels, surpassing $12 trillion. Credit agencies noted a disturbing uptick in late payments. Foreclosure filings, once thought to be relics of the past, began creeping upward again, neighborhood by neighborhood. The comparisons to 2008 became unavoidable. Back then, reckless lending drove the collapse. Today, it was different, but equally dangerous. This time, the strain wasn't fueled by subprime loans alone. It was everyday families pushed to the brink by sky-high prices, rising rates, and stagnant wages. The reaction was explosive. TikTok feeds filled with panicked homeowners wondering if they'd bought at the top. Twitter debates raged between optimists insisting the market was resilient and skeptics warning of a crash bigger than the last. Cable news ran split screens. Wall Street analysts hedging their bets while ordinary Americans shared stories of homes slipping out of reach. The atmosphere shifted. What once felt like speculation now felt like prophecy. Suddenly, the unthinkable didn't just feel possible. It felt inevitable. But history shows crashes don't hit everyone equally. When the housing crash hits, and the signs now scream that it's no longer if, but when, the fallout won't be fair. Ordinary families, many of whom stretch their budgets to chase the American dream, are the first to bleed. Equity evaporates overnight. Mortgage payments become impossible. Foreclosure letters arrive like clockwork. For some, it means losing the home they just moved into. For others, it means losing everything. But while Main Street drowns, Wall Street circles like sharks. Investment firms, flush with capital, wait patiently for prices to crash. When they do, these giants will swoop in to buy homes in bulk. Again, Not to live in, not to build communities, but to rent back to the very families who just lost them. It's a cycle that feeds itself. Crash, consolidation, control. Meanwhile, the shockwaves ripple outward. Foreign investors, once bullish on U.S. real estate, begin to pull back. The stock market wobbles. Pension funds tied to mortgage-backed securities feel the tremor. Protests erupt in cities where housing was already unaffordable. Demands grow for rent control, for reform, for justice. But behind every protest sign is a deeper emotion: betrayal. Americans are waking up to a system that rewards the few at the expense of the many. A system that never really learned from 2008. And while the media spins narratives of market corrections and economic cycles, there's a truth rising louder than ever. But beneath the chaos lies a crucial lesson the media isn't telling you. Behind every bubble lies a deeper truth. And this one isn't just about numbers on a chart. It's about inequality baked into the foundation of our housing system. A system where wealth begets wealth, and average families are told to just work harder, while the rules are rigged from the top. This crisis didn't appear overnight. It was built over years of unchecked speculation, political inaction, and a growing disconnect between policy and people. But here's the good news. Bubbles burst, but truth endures. Panic won't fix what's broken, but knowledge can. Awareness, resilience, and collective action are more powerful than any crash. Don't fall for the hype. Don't let fear dictate your decisions. Understand the cycles and justice. And in the end, when truth meets greed, only one will survive.